Hello, welcome to the Grow Your Wealthy Mindset podcast, where it is all about helping amazing physicians just like you create a wealthy life free from burnout and with the financial security to practice medicine on your own terms. I'm your host, Dr. Elisa Chiang. Welcome back to another episode of the Grow Your Wealthy Mindset podcast. As a life and money coach, I've talked to a lot of physicians about their current finances. The biggest mistake I see physicians make with their money is simply not learning how to manage their money. You may have heard Dr. Una of EntreMD say, "You are the CEO of You Incorporated." What I want to tell you is that you are also the CFO of You Incorporated, meaning that you are your own chief financial officer. And you really need to know where your money is going and what's happening to it. Even if you're working with a financial advisor, you need to understand how your money is being managed and not just hand over your money to someone else to manage without your oversight. Big mistakes I see physicians making by not investing in their financial education include not saving and investing enough money for retirement or financial freedom. They may work a long career and find that they have to significantly scale back their lifestyle if they want to stop working. I've talked to physicians who've been practicing for over 20, sometimes 30 years, who still have a net worth of under $1 million. To put that in perspective, a portfolio of $1 million invested in stocks and bonds will only allow you to safely withdraw about $40,000 a year over a 30-year period to not run out of money. Most physicians I know would not be happy living on $40,000 a year. Many physicians think that if they just max out their retirement accounts, that will be enough. However, that's generally not enough because of how much we make as physicians. You typically want to save and invest 10 to 20% of your gross income for retirement. But that 10% is really for people who start young, like in their late teens or 20s. Many physicians spend extra time with education and training, so saving 10% is generally not enough. Because of starting later, physicians really need to aim for saving and investing 20% or more of their gross income towards retirement. Gross income means your total income before taxes and other deductions that come out of your paycheck. This will make you much more likely to have enough money during retirement so that you can actually continue to live your current standard of living. Depending on your financial situation, you may even need to save and invest more than the 20%. If you're making $200,000 a year, that means dedicating $40,000 a year towards retirement. If you are an employed physician, your 401k or 403b maxes out at $20,500 a year in 2022, and that's up $1,000 from 2021. As of the time of recording this podcast, you could still do a backdoor Roth IRA, which allows you to put away another $6,000 into retirement accounts, but that would still keep you under the 20% of gross income. If you are 50 years old or older, you can contribute an additional $6,500 into your retirement accounts, your 401k or 403b, and an additional $1,000 to your IRA to help catch up. But you'll still actually fall short of that $40,000 that you should be saving and investing each year. And that's on an income of $200,000, which a lot of physicians actually make more than $200,000 a year. And that means saving and investing even more money in order to continue your current lifestyle after retirement. So if maxing out your retirement accounts is not enough, that means that you'll actually have to save and invest money outside of retirement accounts. And I really mean save and invest, because saving money is not enough. That's another mistake I see some physicians making. There are some physicians that are saving at a great rate, but they leave that money just sitting as cash in a savings account. And right now that's making less than 1% interest. Inflation's also been increasing, so that cash is actually devaluing over time. Money needs to be invested in a way so that it can grow and increase in value. Understanding some basics about investing can also make a huge difference on the return of your investment. You don't have to spend a lot of time learning all the nuances of personal finance and investing. If you just spend an hour a week over a few months, you'll really know enough to be a lot further ahead than most people. For investing, you can't just keep it really simple. You don't have to learn how to pick individual stocks or learn about options. You really could just have everything earmarked for retirement placed in a total stock market index fund with a very low expense ratio and just let it ride. That's really the easiest way to invest your money when you have a long time horizon. I know the stock market right now has been pretty volatile. When the stock market continues to drop in value, it may seem scary to buy stocks. But think about it. You're really buying stocks at a discount. These companies are still making money, they're still having profits, and they're still growing. When you actually think about what a stock is, that by buying a stock, you're actually buying a small part of a company, and that buying a total stock market index fund, you're actually buying a small part of every publicly traded company in the United States. Many companies are still doing really well. Yes, there are companies that aren't doing as well, but by having this diversified portfolio, it really all balances out. Our economy is still growing, and investing in the total stock market will outpace inflation. That compounding interest effect will continue to let your money grow and grow. It's also really important to keep your fees low because fees can really cut into your investment returns. If you use a financial advisor to manage your investments, they are probably charging you a fee to manage those investments. A 1% assets under management or AUM fee is very common. It may be lower if you have a large amount of money invested with your financial advisor, but it may also be higher. These financial advisors get paid whether or not your investments do well and increase in value, but they also get paid when it decreases in value. When financial advisors are managing your money, they also don't usually just put them into low-cost index funds with low expense ratios. They're usually putting you into actively managed funds. And no, those funds have expense ratios that could be anywhere between 1 to 1.5% or even 2%. And that's really eroding the returns on your investment. You're probably thinking, well, if they're a financial advisor, they should be picking investments that do better than an index fund. The truth is that very few people can outperform the total stock market performance, even great investors like Warren Buffett. When Warren Buffett outperformed the overall stock market return, it was when he had a lot less capital that he was investing. As he got more and more money to invest, eventually the best he could do was really to match the total stock market. That's because it became harder and harder to find gems with hidden value and great deals. In interviews, Warren Buffett has been saying for many years that people should invest in low-cost index funds. In a 2017 CNBC interview, Buffett said, quote, constantly buy a S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin, end quote. Stock market index funds buy all the stocks of a particular index that holds them. This creates low fund turnover and less trading, which also means less transaction costs. The lower fund turnover and longer holding periods also make stock market index funds typically more tax efficient compared to actively managed funds. Actively managed funds are those who have a fund manager or a team of people who are actively choosing which stocks to buy and hold in the fund. They analyze different companies trying to predict stock price, and that leads them to buy and sell, creating turnover and transaction fees. These fund managers also need to be paid, which also adds to the expense of these actively managed funds. To illustrate how much a difference these expenses can make, I want you to imagine that you have $10,000 that you can invest in either mutual fund A or mutual fund B. Both funds achieve an 8% annual growth over 30 years. Mutual fund A has a low expense ratio of 0.2%. After 30 years, that $10,000 investment will have become $95,184. Mutual fund B has an initial 5% sales load, as well as an expense ratio of 2.5% a year. The initial value of your investment now goes from $10,000 to $9,500 because you're paying that $500 in the initial sales load fee. After 30 years, because of the 2.5% annual fees, even though it's been growing at 8%, it's essentially growing at 5.5%, and that value of that total investment is only $47,348. That means the investment in mutual fund B is worth almost half the investment in mutual fund A, even though both have an 8% rate of return. But because of those additional fees and the difference in the expense ratio, you have that much of a difference in your investment. Now, you may be thinking, that's a large difference in expenses, and you would never buy a mutual fund with a low fee. So let's just take a look at the difference of fees investing in an index fund versus using a financial advisor. Imagine you have a $1 million portfolio. If you invest in a low-cost total market US index fund with an expense ratio of 0.1% and you get a 10% return, in 30 years, your portfolio will have a value of $16,522,289. Now, if you have a financial advisor manage your $1 million portfolio and he charges you a 1% asset under management fee, then he invests in various mutual funds. And let's just say that those mutual funds have a 1% expense ratio, which is actually a little low. I think the average actively managed mutual fund expense ratio is 1.33%. Now, 30 years later, your portfolio is worth $10,062,657. That's more than a $6 million difference in your portfolio. And if you think about retiring at age 60 and living to your 90, then that's 30 years. And you know what? A lot of people live into their 90s. I'm an ophthalmologist, so I see a lot of older patients, and I have a lot of patients in their 90s. Of course, if you're retired and living off your portfolio, you're drawing down on the value of the portfolio over time. So it's not growing that entire time. But you can see how this can really make a difference in how much money you have in that portfolio and how much you can spend during your retirement. That's how knowing just a little bit about finances can really make a huge difference. Listening to this podcast episode may now have saved you tens, thousands, even millions of dollars, depending on how you've been treating your investing so far. Another important point is that second part of that quote from Warren Buffett, the keep buying it through thick and thin, and especially through thin. A mistake that a lot of investors make, not just physicians, is trying to time the market. No one has a real crystal ball. The market will go up, which is what we call a bull market, and it will also go down, which is described as a bear market. Over long periods of time, the market typically goes up, and the stock market is said to typically go up about 10%. No one can time the market perfectly. And there are a small number of days that generate a large portion of returns, and you don't want to miss being in the market on those days. So if your goal is retirement, buy regularly and don't sell. When the stock market is down, you'll be able to buy more shares since stocks are on sale. Having a market downturn early in your investment career can actually be really helpful for building long-term wealth if you're regularly buying. Yes, you're buying as the market goes down, but you'll also buy at the bottom and as the market goes up. Part of my own investing success was that I invested through the 2008 bear market and was also able to invest heavily in my Roth 401k during my intern year in 2010 and 2011. In fact, since coming out of medical school into intern year, we were used to just living off my husband's income. He was a high school teacher. He still is a high school teacher, but he was a high school teacher back then as well. And so we didn't really need the extra income that came in during my intern year. I actually maxed out my Roth 403b that was offered at the hospital where I did my intern year. And since intern year was half in 2010, from July 1st, 2010 to June 30th, 2011, I could actually max it out for both 2010 and 2011. And that has really been a way that propelled my journey to millionaire status. So in summary, remember, the biggest mistake is to not take the time to learn about the basics of investing and personal finances. No one cares about your money, your wealth, your financial wellness more than you do. As a physician, we are perceived by many people as rich, and that kind of puts a target on our backs. Financial advisors seek out physicians, often during our training years, in order to get us hooked with working with them. Even if you use a financial advisor, you need to know and understand enough about what you're paying them and what it's costing you. Now, I am not a certified financial planner, but my words of advice when it comes to the simplest way to save and invest for retirement. Contribute 20% of your gross income towards retirement. Max out all available retirement accounts like your 401k and 403b. Learn how to do a backdoor Roth IRA. Open a brokerage account to invest once all your available retirement accounts are maxed out. Pay attention to expenses. Stock investing does not have to be complicated. You can invest everything towards retirement in a low expense ratio total US stock market index fund, and you will do better than most non-index fund investors. I really don't have data to back up that statement, but I totally believe it's true. It can be an index mutual fund or an exchange traded index fund. Both will get you to your goal. And don't jump in and out of the stock market. No one can accurately time the market. Just keep investing regularly, something we call dollar cost averaging. And don't worry about downturns. Keep investing. If the goal is retirement, it's a long-term goal and the market is going to recover. You can look forward to future episodes on how to pick and work with a financial advisor if you choose to do so, as well as learning more about all the different types of accounts for investing. Until then, keep working on growing that wealthy mindset. Thanks for listening. If you enjoyed this episode, please subscribe and let me know by leaving a review. It really helps get the word out. And now the disclaimer. I am not a certified financial professional, and this show is really just for your education as well as your entertainment. I'm also a physician, but I'm probably not your physician. So if you need any medical advice, please consult your own physician. Thank you.